Tonight we focus on a seismic shift in the global auto industry. Honda is closing some of its car factories in China. This marks a dramatic pivot for a company that's been a major player in China for decades. The move signals a new era as the traditional auto world faces fierce competition and rapid technological change. China, once just the world's largest car market, is now the epicenter of the electric vehicle revolution. Honda, long known for reliable gasoline cars, is under pressure from a new wave of innovative Chinese EV makers. These local companies are redefining cars with cutting-edge tech and electric power, capturing the imagination of consumers. Honda's closures aren't just business news, they're a sign of a global trend reshaping entire industries. The shift away from gasoline engines is happening faster than anyone expected. What's unfolding in China is a preview of the future of transportation worldwide. Legacy automakers must adapt or risk being left behind in this electrified race. Honda isn't leaving China, but it's making a massive strategic pivot. By shutting gasoline car plants, Honda is freeing up resources to invest in electric vehicles. The transition is complex and costly, but Honda's leadership sees it as essential for survival. The road ahead is challenging, but the direction is clear. Electrification. To understand Honda's move, look at the meteoric rise of Chinese EV brands like BYD, NIO and XPeng. These companies, born electric, have leapfrogged legacy automakers by designing cars around batteries and software from the start. They're fast, agile, and tech-savvy, launching new models at breakneck speed. Their vehicles boast advanced features and strong appeal to younger Chinese consumers. For many buyers, domestic EVs are now more desirable than foreign gasoline cars. The Chinese government fueled this revolution with subsidies, incentives, and a vast charging network. This support built a robust supply chain and gave local brands a cost advantage. The result, a fiercely competitive market with EVs at every price point. Foreign brands like Honda are squeezed by intense price wars and shifting consumer preferences. Chinese consumers now have more choices than ever, and they're choosing innovation. For Honda, the writing is on the wall: adapt to the EV era, or fade away. Honda's decision to close factories is a direct response to falling sales in China. Once a growth engine, China has become a tough market for Honda's gasoline cars as EVs surge in popularity. The drop in market share is significant. Showrooms that once buzzed with interest in Civics and CR-Vs are now quiet. Meanwhile, local EV brands are drawing crowds and dominating sales charts. Honda's factories are running below capacity, an unsustainable situation. BYD, once a battery maker, now outsells every other brand in China, including Volkswagen. The rapid ascent of Chinese EV makers has left legacy automakers scrambling. Honda's plant closures are a pragmatic response to this new reality. Maintaining underused factories is costly and inefficient. The company must align its production with actual demand to stop financial losses. The era of gasoline dominance in China is over for Honda. Honda's closures will slash its gasoline car production capacity in China by half. The plan targets plants at both of its major joint ventures, cutting capacity from 960,000 to about 480,000 units per year. Including EVs, Honda's total China capacity drops to around 720,000 vehicles, down from over 1 million. This is a major retreat, reflecting the end of rapid gasoline car expansion. Overcapacity drives up costs, so consolidating production is crucial for profitability. By closing underused plants, Honda can focus on leaner, more efficient operations. The scale of these cuts shows just how tough the market has become. Honda's leadership doesn't expect a quick rebound for gasoline cars. The company is shifting from volume to value, and from gasoline to electric. It's a bold move to secure a future in the new automotive order. For years, Honda's success in China relied on joint ventures with GAC and Dongfeng. Now both partnerships face major changes as plant closures loom. The first closure, at a GAC Honda plant, is set for June 2026, A Dongfeng Honda plant could follow in 2027, marking a coordinated scale back. This phased approach gives partners time to adjust, but signals a shift from expansion to consolidation. The closures are more than numbers. They mark a turning point in global-local automaker relationships. The focus now must shift to developing and producing electric vehicles. The era of assembling foreign-designed gasoline cars in China is ending. Joint ventures must evolve or risk obsolescence. Honda's plant closures are part of a bold pivot to electric vehicles. The company aims for 100% of global sales to be EVs or fuel cell vehicles by 2040. Billions are being invested in R&D, battery tech, and new EV factories. China is both a testing ground and a critical market for Honda's electric ambitions. Honda is developing EVs tailored to Chinese tastes and building dedicated EV production lines. Closing old plants frees up resources for this transformation. The EV market is crowded and competitive, but Honda is betting on its engineering and brand reputation. Success will require standout design, technology, and value. Honda's future in China, and globally, depends on winning the electric race. The company's determined to reinvent itself for the new era. Honda's shift to electric comes with a massive price tag, up to $15.7 billion. The investment covers everything from R&D and battery tech to retooling and building new factories. Shutting down old plants is costly, involving equipment, environmental cleanup, and workforce support. Building new EV factories requires advanced robotics and specialized machinery. Honda must also retrain thousands of engineers and technicians for the electric era. Software, battery chemistry, and electrical systems are now critical skills. The company is investing heavily in training and hiring new talent. This transformation is as much about people as it is about factories. Honda's financial commitment shows how seriously it takes the challenge. The risks are high, but so are the potential rewards. Success will depend on Honda's ability to manage this complex, costly transition. Factory closures have a profound human impact. Thousands of workers at GAC Honda and Dongfeng Honda face uncertainty and job loss. The ripple effect hits suppliers, local businesses, and entire communities. Honda and its partners must manage the transition responsibly, offering severance and retraining. Not all workers will easily find new roles, especially those with skills tied to gasoline engines. The shift to EVs requires new expertise, leaving some behind. This is a microcosm of a global challenge as the auto industry transitions to electric. Millions of traditional auto jobs are at risk worldwide. Managing this workforce shift will require investment in retraining and education. Honda's closures in China symbolize a new era for the auto industry. The momentum has shifted decisively from gasoline to electric power. Legacy automakers face fierce competition from innovative Chinese EV brands. The future of car manufacturing is being shaped in China's fast-moving market. Lessons learned here will influence the global industry for years to come. Honda's transformation demands not just investment, but a cultural shift toward agility and tech focus. The company's future depends on its ability to lead in the electric era. This story is bigger than Honda. It's about the global shift to sustainable transportation. Automakers everywhere must balance the decline of gasoline with the promise of electric. Honda's bold choices in China preview the tough decisions all car makers will soon face.